Welcome to the deep dive. Today, we're tackling something pretty significant. The idea that the U.S. could face a financial crisis, maybe even one it brings on itself.
Hmm.
You've probably seen all the headlines, the economic news swirling around. It's easy to feel a bit lost, especially with things like, well, what one source called on-again, off-again tariffs shaking up the market.
That's right. And, things can feel complex fast. So our aim here for you listening is really to boil this down. We want to understand the core risks, what could actually trigger a crisis, and maybe what can be done about it. We've been digging into some insightful analysis for this.
Okay, good. So let's start with the basics, maybe. Financial crisis, it's a term we hear a lot. Is there a sort of typical pattern these things follow?
Yeah, there often is, historically speaking. It usually starts with some kind of catalyst, a trigger. And the pieces we looked at suggest U.S. policy decisions could potentially be that trigger this time.
Policy decisions.
Then debt always plays a huge role. You have investors using borrowed money leverage, basically, to try and boost their returns.
Right, leverage, more potential upside, but also.
Exactly, more potential downside. It magnifies everything. So if the prices of the assets they bought start to fall sharply, the people who lent them the money get nervous. They might ask for more collateral or try to get their money back.
And that's the domino effect, people selling assets.
Precisely. Falling prices trigger margin calls, forcing more sales, which pushes prices down even further. It can become a real downward spiral.
And if it gets bad enough?
Well, if the asset values drop below what's owed, the lenders start losing money too. And if those losses are big enough and spread far enough, they can threaten the whole financial system, the wider economy even.
Which is when governments step in, bailouts.
Often, yeah. That's when you hear about bailouts using tax funds, because the alternative seems, well, even worse.
Okay, so that's the general kind of grim pattern. Thinking about the U.S. right now, what specific weaknesses or vulnerabilities do our sources point to? What are the current concerns?
There are a few key ones highlighted. First, a sense that financial companies might not have enough readily available resources, enough capital to really absorb big losses and stop them spreading, like a safety net that's maybe a bit thin in places.
Not enough cushion, basically.
Kind of, yeah. Especially thinking about preventing contagion, that spread effect.
Okay, what else?
Another major point is hedge funds, specifically how much leverage they seem to be using in the U.S. Treasury market.
The market for government bonds.
Exactly. It's a crucial market.
Yeah.
Because they borrow so much, even small jumps in volatility, uncertainty, could force them to sell off their holdings very quickly. And that could cause serious disruption there.
Fragile. And what about the really big players, the systemically important banks?
Yeah, the huge ones whose failure could, theoretically, bring down the system. The analysis suggests they might not have enough of their own capital, their equity, to withstand a really, really severe downturn, a worst-case scenario entirely on their own.
Right, so potential weaknesses in firms, hedge funds, big banks, anything else?
Well, yeah. Adding to the mix is the U.S. government's own financial situation. The sources point to large and growing budget deficits.
To national debt.
Exactly, leading to a very significant sovereign debt load, apparently the largest since World War II, relative to the economy. This kind of backdrop just adds another layer of risk and complexity.
Okay, so we've identified these vulnerabilities, but fixing them isn't straightforward, is it? The sources mention challenges there, too.
Not at all, no. It's stressed that these are deep-seated issues, they take time to fix, and there are headwinds. For instance, some regulators are apparently facing pressure, administration demands, to cut staff, maybe significantly.
Cut staff. When you're worried about instability, that seems counterintuitive.
It certainly raises questions about capacity,
Yeah.
And then there's the political side. Actually getting agreement to, say, force banks or others to hold more capital or post more collateral. It's tough.
Especially if things already feel shaky.
Right. The analysis makes a good point. Demanding more capital right when a crisis might be brewing could actually make things worse in the short term. It could tighten conditions just when you don't want them to.
Okay, so if the big fundamental fixes are slow and difficult, what should the financial authorities, the regulators, be focusing on right now? What are the immediate priorities?
According to the pieces we read, three main things. First, identifying the weakest links, really pinpointing where the biggest risks are hiding in the system.
Finding the potential trouble spots.
Exactly. Second, just keeping markets running smoothly, making sure trading doesn't seize up. And third, ensuring that firms that are fundamentally sound still have access to cash, liquidity.
So they don't get forced into fire sales or fail just because they can't get hold of ready money.
Precisely. Avoiding unnecessary failures just because of temporary funding blockages.
And to do all that, they need good information, presumably. Are they better equipped now than, say, before 2008?
Yes, significantly better. According to the sources, regulators now have access to way more detailed data on transactions.
More granular, as they say.
Yeah, exactly. It lets them look much deeper into what firms are actually doing, their positions, and spot potentially dangerous levels of leverage that might have been invisible before.
So a clearer picture of the risks.
Hopefully, yes. And they can also use surveys, talk to market participants to sort of stress test scenarios mentally,
Yeah.
try and figure out how things might play out if X or Y happens.
Okay.
The analysis even mentions the Archegos collapse in 2021. The suggestion is that maybe with this kind of data, the risks there could have been spotted earlier, potentially allowing for some action beforehand.
Interesting. Okay, let's talk interventions, specific tools. The Fed's standing repo facility was mentioned. What's that about in this context?
Right, the repo facility. It's basically a standing offer from the Federal Reserve to certain banks and dealers. They can come to the Fed and temporarily swap Treasury bonds for cash.
So it provides a ready source of liquidity.
Exactly. It's a backstop specifically for that crucial Treasury market, designed to prevent funding shortages there among those eligible institutions.
Ah, eligible institutions.
Yeah.
But there's a gap, isn't there? Who's not eligible?
That's the key limitation highlighted. Hedge funds can't use it.
Even though you just said they're highly leveraged and potentially fragile in that same market.
Correct. And hedge funds actually play a role, usually, in keeping prices aligned between treasuries and related futures contracts. So, the source suggests the Fed needs to be ready to step in and perform that function itself if the hedge funds suddenly pull back during a crisis.
Wow, the Fed effectively replacing the hedge funds temporarily. That's quite a thought. And how does that compare to other ideas? Like, wasn't there a mention of maybe loosening bank capital rules?
Yeah, the source contrasts that idea attributed in the piece to Treasury Secretary Scott Bessent with the Fed intervention idea. The analysis we read definitely seems to favor the Fed being prepared for direct market intervention as a better way to keep things stable rather than cutting bank capital buffers.
Okay. Let's broaden the view now. This isn't just a U.S. issue, right? Global finance is all interconnected.
Absolutely critical point. Foreign financial institutions hold huge amounts of assets denominated in U.S. dollars, and they often fund these holdings by borrowing dollars.
So if there's a crisis in the U.S.
That dollar funding could just evaporate
Well,
very quickly. And that could trigger problems, serious problems, for those institutions overseas, spreading the crisis internationally.
and that's where things like the Fed's currency swap lines come in.
Exactly. These are agreements the Fed has with other major central banks like the European Central Bank, the Bank of England, Bank of Japan, and others.
How do they work?
They allow the Fed to provide U.S. dollars to those foreign central banks. Then, those central banks can lend the dollars out to banks in their own countries. It's a way to prevent a global dollar shortage from making things much worse.
But it's not always easy to use them politically.
That's the potential snag mentioned. Optics. Providing support even indirectly to foreign banks during a domestic crisis can face political pushback.
Understandable, perhaps.
Sure. But the argument made strongly in the source material is that using these swap lines is actually in America's own best interest. Preventing a global fire sale of dollar assets protects U.S. markets and U.S. firms from damaging feedback loops.
Right, because those foreign institutions might be forced to sell U.S. assets, driving prices down here.
Precisely. It's about preventing that wider contagion.
So pulling this all together, what's the main takeaway, this idea of a self-inflicted crisis? How seriously should we take it?
The core message from the analysis is, very seriously,
Yeah.
policymakers really need to grapple with the real possibility that current conditions and policy choices could lead to a major financial disruption originating from within the U.S.
It's not just a theoretical exercise.
No. The piece argues it's a plausible scenario. And because of that, regulators everywhere, not just in the U.S., need to be prepared. They need to be thinking through these risks and dusting off their contingency plans.
Okay. So for everyone listening, the key point seems to be the current mix of economic uncertainty and specific policy actions has created real vulnerabilities in the U.S. financial system. Weak spots that could potentially trigger a crisis. And while the regulators do have better tools and more information than before, being proactive, being ready to act decisively and maybe unconventionally, like with market interventions or swap lines, that's going to be crucial.
Absolutely. Vigilance and preparedness are key.
Which leaves us with a final thought to ponder, perhaps. Given how interconnected everything is, as you said, If a crisis like this did happen, seemingly self-inflicted in the U.S., what might be some of the less obvious ripple effects, the unforeseen consequences spreading far beyond American shores?
That's a really important question. The knock-on effects could be complex and far-reaching in ways we might not immediately anticipate. Definitely something worth keeping in mind as we watch how things develop.